Good morning everyone and welcome to this morning's update of morning markets, where we will discuss yesterday's meeting of the US Federal Reserve and the policy decision which was to raise interest rates by 0.75 percentage points. Now this was expected by markets, but what wasn't expected was the accompanying language and the guidance from Chairman Powell, and that is what impacted markets adversely through yesterday's evening session. And you can see that global equities underperformed, led by the US. Now it's important that we cover several points which were underlying messages within the Federal Reserve meeting yesterday. The first is that the FOMC, the Monetary Policy Committee, now expect interest rates to rise to above 4% by the end of the year, and in fact end the year at close to 4.5%. So the highest interest rates in over 15 years. And just recall that only 12 months ago, the Federal Reserve expected interest rates to only go as high as 0.3%. So expectations and forecasts have adjusted aggressively over the last 12 months. More importantly was the impact upon growth expectations over the next 12 months. The Fed now expect growth to remain below trend until 2024. That is, that the interest rate increases that they are taking are likely to have an adverse impact upon the economic potential of the US economy. And just as importantly, the US Fed now expect US unemployment to rise by 0.7 percentage points over the next 12 months to around 4.4%. What's important is the level of rise. We have never seen a rise in unemployment in the US of more than 0.5 percentage points without there being an accompanying recession. So the US Federal Reserve are being very aggressive in their monetary policy and are indicating that they are prepared to slow the economy substantially, and it's all to bring down inflation. And that is why they are acting so aggressively. Inflation is much too high, and the underlying components of core inflation, or these stickier measures, are too persistent. And the Fed are now indicating that with rates being high and going higher, they are prepared to keep policy rates at that level for as long as is needed to bring inflation down towards target. And this is why markets are reacting so adversely. The cost of businesses to raise capital in markets is increasing to levels not seen for over 15 years. And the rapid change in language from the Fed is moving away from the soft landing that was communicated in May, for example, towards more explicit language that rather than the interest rate increases impacting inflation rather than growth, they're now more likely to impact growth and have a lagged impact upon inflation. And this is why unemployment is expected to rise, growth is expected to slow, but inflation is expected to take another 2 years to come back towards target. Now, what's the read-through for other markets? Well, recall that earlier in the month, we saw a 0.75 percentage point increase in the policy rate from the European Central Bank. The Federal Reserve did the same last night, and markets are braced for the same from the Bank of England today. So the US Federal Reserve are not alone. They are really just keeping pace with all the other central banks. And the global level of tightening is what's also impacting other asset markets, such as bond markets, as well as global equity markets. And all of these central banks are effectively raising interest rates because inflation is much too high. And even if we strip away the impact of the war in Ukraine and Russia upon energy prices and how that impacts headline inflation, core inflation across all of these economies remains much too high. And the central banks are all communicating that some rise in unemployment is necessary in order to cool labour markets and perhaps bring down nominal wage growth. So we do expect another substantial increase in interest rates from the Bank of England today. But please do join us tomorrow when our Chief Investment Officer, Jeff Casson, will update you on the guidance from the Bank of England and give some preparation for the forthcoming mini-budget from the Chancellor. Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.